Take a look at this chart. It tracks something called the global bond liquidity, which is a measure of how easily government bonds can be bought or sold without triggering a big price movement. When this line falls, it means liquidity is strong, and when it rises, it points to a shortage in liquidity. Recently, this index has spiked to its highest level on record since 2007, telling us that global bond market liquidity just got exceptionally tight. The last two times it reached similar levels were back in 2022 and 2008. Both of these instances coincided with sharp stock market drawdowns as an economic downturn unfolded. Yet today, stocks remain at record highs, and US GDP is still expanding at 3.8%, not the type of backdrop typically seen during such severe bond market liquidity stress. This big disconnect could have major implications for the US economy. To understand what's really happening today, we must first go back to 2022. Back then, the Fed raised rates at one of the fastest paces in decades, even to the point where it's actually higher than the 30-year government bond yields. That meant investors could earn better returns just by holding cash or money market funds, making older bonds with lower yields much far less attractive. As a result, money started shifting out of long-term bonds and into cash-like assets, draining demand from the bond market. At the same time, governments were issuing a record amount of new debt, flooding the market with supply just as buyers were stepping back. This is a classic case of bond liquidity problems, a supply and demand imbalance. And along with inflation, that tightening in bond markets played a major role in triggering the market downturn. In 2008, the story was a little different. The housing bubble burst, major banks collapsed, and funding markets froze, making it difficult to trade bonds, hence the liquidity drops. But once again, liquidity stress and market downturns come hand in hand. In both of those cases, the stress was centered in the United States, home to the world's largest government bond market. But the liquidity index isn't just about the US. It reflects conditions across all major bond markets globally, from the US to other major bond markets like Europe, China, and Japan. And whether today's liquidity problem spills over into the economy depends on where that stress is actually coming from.